Imagine waking up to see silver at $83, your broker's chart looking calm, boring, and completely disconnected from reality. On the other side of the planet, the same metal is selling for $95, and the inventory feeding that demand could be gone in about 24 days. Institutions are quietly draining vaults. A volatility powerhouse just snapped up over $1 billion worth of a silver ETF, and the mechanism that decides the price might be the same mechanism holding it underwater. If that's the case, what happens when the dam finally cracks? This is Source Code, OG John AG, on the mic. The defining feature of this market right now is not a buzzword you see on CNBC. It's a simple, brutal fact. Nobody knows. No one can tell you how this war resolves. No one can say what Friday's data print will do to the dollar. No one can say whether the next headline out of the Gulf sends oil screaming to $100 or crashing back to $70. In that kind of landscape, patience isn't cowardice. Patience is your edge. Because this is the kind of tape that hunts. The market right now will probe every weakness in your process and rip it wide open. Short-term traders especially, if your plan has any fuzziness in it, any "I'll figure out the exit when I get there," any "I'll hold a bit longer and see what happens," this environment is going to find that crack and pry it apart. The people who come through stretches like this intact are not necessarily the ones with the prettiest macro thesis. They're the ones who knew precisely what they were going to do before price moved, not after. So before we dive into the numbers, and there is a lot to unpack today, ask yourself bluntly, do you have a plan or do you have a wish? Because this market has zero interest in your wishes. If you're looking at this landscape calmly, prepared instead of panicked, able to see the picture with a clear, objective lens, drop OG in the comments. I see every single one. Now let's step into the silver story. As I'm recording this, silver's Western paper price is about $83 after backing off from $86.90 and fading lower. That's the price the world quotes. That's the number your brokerage app flashes at you. But while the COMEX paper price sits at $83, Shanghai is trading at $95. That's a $12 premium. Same metal, different venue, very different signal. The paper chart is one narrative. The data underneath it is something else entirely. Start with COMEX open interest, because that's where the picture really starts to focus. Total open interest in COMEX silver has dropped to 113,326 contracts. The all-time high was 244,075 contracts back in February 2020. Right now we're staring at the lowest open interest since September 2013. The paper arena, the casino that prints the reference price the whole planet uses, has seen participation collapse by more than half from the peak. The speculators are walking away from the tables, and when a rigged casino loses players, its ability to dictate the line starts to erode. Layered right on top of that, COMEX silver total inventory now sits at about 352 million ounces, a fresh low for the past year. Nearly 3 million ounces left the exchange in a single session. In just the last 30 days, more than 53 million ounces have been pulled, roughly a 13% drawdown in 1 month. Registered silver, the category actually available for delivery, has fallen to about 87 million ounces. The leverage ratio on that registered pool is now around 6.68 to 1. Translate that: for every ounce of physical silver in the registered vaults, there are roughly 6.5 ounces worth of paper promises stacked on top of it, and that registered number is still slipping. So when someone tells you calmly, the physical market is fine, your follow-up question is simple. Explain a 6.68-to-1 leverage ratio at a 1-year inventory low with 3 million ounces walking out the door in a day. That's the setup. Now let's walk into the delivery data, because this is where the signal turns from retail noise to institutional intent. On Tuesday alone, 607 silver delivery notices were issued. That's not forum chatter, that's the formal mechanism lighting up. On the issuing side, Goldman pushed out 400 contracts, Macquarie pushed out 200. On the stopping side, Bank of America took in 195 contracts, JP Morgan took in 145. Total March silver deliveries on COMEX have now climbed to about 28.47 million ounces of physical being demanded through the official delivery channel. These are not guys stacking a few rounds in their basement. This is large money, large balance sheets, deliberately using the exchange infrastructure to pull physical silver off the system. Flip to gold. On the same day, 1,215 gold delivery notices hit. Goldman issued 590. Wells Fargo issued 395. JP Morgan stopped 847. Cumulative March gold deliveries have reached roughly 362,800 ounces. So step back. The big players are not quietly rolling into paper. They are standing up and asking for metal. Now here's the twist that makes those inventory and leverage numbers cut deeper. Since February 9th, retail investors sold roughly 15 million ounces of physical silver. That kind of selling should have eased the strain on the system. It should have relaxed the pressure. It didn't. The 1-month silver lease rate, something that in a healthy functioning market should hover around zero, is still elevated. The 1-year swap rate is still flashing distortion, still pricing in backwardation risk. Retail dumped 15 million ounces back into the pipe, and the stress indicators barely flinched. That's your context for what I'm about to say next. Paper markets haven't just failed to reflect physical tightness. They have actively blocked it from being priced in. The very mechanism that generates the global silver benchmark is the same mechanism that sits on that price. So ask yourself, what happens if and when retail flips back from selling to buying? Now shift to China, because Shanghai is telling a very different story from New York. Silver inventories at the Shanghai Futures Exchange have dropped to about 9.5 million ounces, with more than 400,000 ounces pulled in a single day. If that pace continued, SHFE's silver would be effectively gone in roughly 24 days. Separately, the Shanghai Gold Exchange is holding around 14.3 million ounces of silver. Add them together, SHFE plus SGE, and you get total Chinese exchange silver inventory of about 752 metric tons, around 24.2 million ounces. That's the lowest combined level in roughly a decade. At the same time, the Shanghai silver premium is sitting at about $12 above Western spot. Silver trades around $83 on your screen and about $95 in Shanghai. That gap survived the whole paper washout. In other words, people paying for actual metal in China are not transacting anywhere near the number you see in your brokerage account. They're living in a different price world. Walk the logic forward. Either silver has to reprice substantially higher to attract fresh inventory into that Chinese demand center, or Beijing is going to have to step in and stop withdrawals to keep the system from bleeding out. There is no magical third option hiding in that math. Now we need to talk about Jane Street, because this is the piece that's setting off alarms in professional trading circles right now. In the most recent 13F filing with the SEC, Jane Street disclosed that in the fourth quarter of 2025, they bought roughly 20.6 million shares of the iShares Silver Trust, ticker SLV. In the previous quarter, they held around 41,000 shares. That's not a typo. That's about a 500x increase in one quarter. At current prices, that position clocks in around $1.3 billion, which makes Jane Street the largest reported holder of SLV, bigger than BlackRock, the sponsor of the fund itself. Over that same period, Morgan Stanley cut its position by about 3.7 million shares. BlackRock, they didn't add any. Now layer in how Jane Street actually operates. More than 87% of their disclosed portfolio is tied to options. The entire firm is structured to manufacture and monetize volatility, cross-asset, cross-venue, across the curve. That's their DNA. So when an entity engineered to live off volatility suddenly becomes the dominant equity holder in a physically backed silver ETF, at the exact moment the physical and paper markets are diverging like this, the obvious question on the street isn't, are they bullish silver? The question is, which direction is the volatility bet? Because a 500x ramp-up in a single quarter could represent a straightforward long position, or it could be the anchor leg of a more complex structure designed to profit from keeping prices pinned, while still controlling the largest paper stake in the vehicle that claims to hold the metal. Now add one more detail. The custodian for SLV is JP Morgan, the same JP Morgan that in 2020 paid $920 million to resolve federal charges related to 8 years of spoofing in the precious metals markets. That's not message board speculation. That's a concluded U.S. enforcement action. Within trading circles, people are now flagging price patterns in silver that echo behaviors previously identified in Bitcoin, patterns that were allegedly linked to Jane Street and reportedly stopped showing up after the Terraform lawsuit hit daylight. Right now, Jane Street is facing allegations that touch 3 separate areas: their role in the Terraform ecosystem collapse, manipulation findings around 18 Bank Nifty expiry sessions in India, the recurring Bitcoin microstructure pattern. They have denied all of it. No U.S. regulator has formally opened a case on silver specifically. On paper, there is no official silver investigation underway, but the level of scrutiny is rising, and when you stack current behavior on top of the documented past, it becomes harder and harder to wave it away. So zoom out. Because silver is not trading in isolation, and the backdrop forming behind all of this is one of the most aggressive energy setups we've seen in decades. As I record this, 3 separate energy shock fronts are live at the same time. Number 1. Iran. Roughly 20% of the world's energy flows through the Strait of Hormuz, which is now under explicit, declared Iranian naval oversight. The Pentagon estimates the ongoing conflict is burning about $1 billion per day. Iran reportedly has the capacity to churn out up to 10,000 drones every month, at roughly $35,000 to $50,000 apiece. US interceptors used against those drones can cost between $1 million and $3 million each. Do that math. One side spends tens of thousands per shot, the other spends up to millions to knock each one down. Goldman has already put it in print. If export volumes through Hormuz stay constrained for just 5 more weeks, Brent crude likely tags $100 a barrel. And Iranian officials have gone public with their red line. If Washington and Tel Aviv push for regime change, they say final strike missiles will target the Dimona nuclear facility and all regional energy infrastructure. That is not rumor, that is a named threat directed at specific high-value targets. Second, Qatar. Roughly 20% of global LNG supply went offline today out of Qatar, with current estimates calling for about a 2-week restart window. The market reacted instantly. Coal futures ripped about 7.2% higher to roughly $138 a ton, as power producers pivoted to the next available burnable. When LNG disappears from the grid, coal is the contingency plan. That substitution effect was priced in within hours. Third, Russia. Putin has started openly floating the idea of redirecting Russian gas away from Europe entirely. His public framing is straightforward. If Europe is going to shut the door in a month or 2 anyway, it might be more profitable to cut them off now and secure reliable partners elsewhere. So you have 3 stress points all tightening at once. Crude flows through Hormuz under threat. LNG exports out of Qatar, temporarily knocked out. Pipeline gas from Russia to Europe hanging on a political thread. Oil, LNG, pipeline gas, all wobbling at the same time. WTI is around $75 as I'm speaking. Goldman's $100 Brent target is based only on continued pressure in Hormuz. It does not yet fully incorporate a prolonged Qatar disruption, plus a meaningful Russian reroute hitting simultaneously. Now plug that into history. The closest analog we have is the 1970s, and what happened in that decade is worth studying with a cold eye. The standout performers back then were oil, precious metals, chemicals and related materials. Why? Because that era experienced exactly the kind of mix we're flirting with now: energy supply shocks, rising geopolitical fault lines, pressure on the dollar's credibility, and a stagflationary backdrop, slower real growth paired with persistent inflation. You don't study the 1970s because history photocopies itself. It doesn't. You study it because the structural rhyme is loud: scarce energy, debased currency, tangible, real-world assets outpacing financial claims. The mainstream chorus will tell you this time is different. It always does. That's not analysis. That's a reflex. Meanwhile, the broader cross-asset tape is quietly narrating its own story. Equity markets in Korea, Thailand and Dubai slammed into limit-down territory. US stock indices green on the day. Germany's DAX clawed back about 3% off its lows. In the commodity complex, aluminum futures took out their January 29th highs and jumped roughly 5%. On the digital side, Bitcoin traded up to about $74,000. Gold printed around $5,135, and then almost on cue, headlines broke that Venezuelan oil would be flowing again after Trump announced a shift in posture. So you have to ask, is that timing just optics or strategy? If traffic through Hormuz tightens further, if Qatar's LNG remains constrained, if Russian gas starts peeling away from Europe at scale, then every spare barrel starts to matter, politically and psychologically. Venezuela offers a convenient talking point. Don't worry, we've unlocked another source. It's a way to project control. But drill down into capacity, and the picture changes. Venezuelan output cannot meaningfully offset a serious Hormuz disruption. It doesn't come close. And we've seen this movie before on the military front. Naval escorts shepherding tankers through contested waterways. Trump already authorized that play. The oil market shrugged. Prices gave up the knee-jerk drop and marched right back. You're talking about burning roughly $1 billion a day on a conflict where the other side can mass-produce 10,000 drones a month at $35,000 a shot, while you're fielding intercepts that cost up to $3 million each. That math does not work. Not for long. The market understands that. Venezuela is a headline bandage. The underlying wound is somewhere else entirely. A system trying to juggle too many fragile energy choke points at once, under-escalating geopolitical risk. And all of that is happening in the background, while physical silver inventories drain, Chinese exchange stocks slide toward decade lows, Shanghai trades double-digit premiums, and a volatility powerhouse quietly becomes the biggest stakeholder in the largest silver ETF on Earth. This is not a normal backdrop, it's a layered one. So let's be straight about the other side of this, because you don't need cheerleading, you need a map. Silver has backed off that $86.90 spike and is sitting around $83. The dollar index is moving sideways, building its own base. On the lower time frames, neither chart is giving you a clean, confident signal. I'm not going to pretend otherwise. The framework I laid out in the last video is still the framework today. If the DXY, the US dollar index, can push higher and close above the January 15th level with real follow-through, you should expect more downside pressure on the metals. That's the line in the sand. That's the number worth having on your screen. Until we see that resolved, the short-term picture is genuinely muddy. There is no obvious high-conviction setup, no well-defined edge. Anyone telling you there's a fat-pitch high-probability trade in this exact moment is either overestimating their own read, or they're trying to move product. As long as the dollar is coiled like this, short-term trading in silver and gold is a low-odds game. If I were running a short-duration book right now, I would not be pressing it in this tape. Step away. Because in a real liquidity squeeze, forced selling doesn't stop to ask which asset deserves to go down. It just hits everything. Strong fundamentals, weak fundamentals doesn't matter. Margin calls do not discriminate. That risk is still live. These are not conditions you swagger into and try to conquer. These are conditions you respect. Now layer on the calendar. Thursday brings weekly unemployment claims. Friday brings non-farm payrolls. Both are high-impact, dollar-sensitive prints. Markets know it. That's why so often you see this kind of sideways chop into big data, price action that can look like stealth accumulation, but just as often breaks violently in the opposite direction of what everyone felt was building. With that backdrop, I would not be trading with leverage here. Not in metals, not in equities, not in crypto, not in anything. Pull up the tape across assets. You're seeing jagged intraday moves, directionless swings, algorithmic spikes that rip one way on a headline, only to reverse completely when the next headline hits 30 minutes later. That's not a fertile environment for clean technical reads. That's a minefield. Low probability conditions across the board. If someone is telling you this is simple right now, if they're handing out crisp little charts with arrows and guaranteed setups in this environment, they are not giving you a gift. They are selling you something. Nobody has certainty here. Not me. Not them. Not the guy on TV. Anyone claiming rock-solid certainty in this tape is not doing analysis. They're performing it. So you separate your strategy by time frame. If you're a long-term stacker, your job is not to obsess over every candle. Your job is to monitor the true signal stack. Lease rates, delivery notices, Shanghai Futures Exchange withdrawal pace, and the Shanghai premium over Western spot. Those are your gauges. The paper price flashing on your app minute by minute is mostly noise, especially in an environment where we've already established that the mechanism setting that price is also distorting it. If you're a short-term trader, the bar is higher. If you don't have a clearly defined edge, a precise entry, a mapped-out exit in both directions, and a specific time window you're operating within, you're not really trading this market, you're just gambling inside it. And remember, this market right now is built to seek out every gap in your risk plan and twist it. This is why I keep hammering the same point. In a market like this, the weak spot is never out there. It's always in your own process. The traders who make it through stretches like this aren't the ones with the fanciest macro narrative, the edgiest Twitter thread, or the wildest price target for silver or gold. They're the ones who can answer 3 questions before they put a single dollar at risk. What exactly am I going to do if I'm right? What exactly am I going to do if I'm wrong? And how long am I willing to wait before I decide which one it is? If you can't answer those cleanly, in advance, the market will answer them for you, and you probably won't like its version. So step back and look at what we've just walked through. On the paper side, COMEX silver open interest has fallen by more than half from its 2020 peak, down to levels we haven't seen in over a decade. Participation in the casino that writes the reference price has dried up. At the same time, total silver inventories on that exchange have bled down to a 1-year low, with millions of ounces walking out in single sessions and registered metals sitting on a 6+1 leverage ratio. On the physical side, retail just sold 15 million ounces, and the stress gauges didn't exhale. Lease rates stayed elevated, swap curves stayed kinked. The underlying strain didn't resolve. In China, the exchanges are holding the smallest combined silver stack in roughly 10 years, with Shanghai trading a double-digit premium over Western spot and inventories on a trajectory that, if unchecked, empties them in something like 3+ weeks. Either price climbs to call in new metal, or withdrawals get choked off. That's not drama, that's arithmetic. Over here, big institutions are not passively rolling paper. They're standing for delivery, in silver and in gold. At the same time, one of the most sophisticated volatility machines on the planet quietly ramps its SLV position by 500x in a quarter, becoming the largest reported holder of the fund, custodied by a bank that already paid nearly $1 billion to settle metal spoofing charges. Layer on top of that 3 concurrent energy shock fronts: Iran and Hormuz, Qatar's LNG outage, and Russia's potential gas reroute, and a macro rhyme with the 1970s, where oil, metals, and hard assets led, while fiat and paper structures struggled to keep up. Put it together, and the picture isn't silver to the moon tomorrow. The picture is structural tension building in the plumbing, while the surface price tries to pretend everything is normal. So where does that leave you? If you're a stacker, it means your job is not to chase every spike and dip. Your job is to understand that the quote on your screen is being generated by a shrinking leveraged paper system sitting on top of a tightening physical base. You watch the real indicators. You decide what percentage of your net worth you're comfortable holding in real metal. Then you accumulate on your own terms, not the market's mood swings. If you're a trader, it means right now may not be your moment. There are seasons where aggression pays and seasons where capital preservation is the play. The current mix of whipsaw price action, event risk headlines, and unresolved dollar direction puts us firmly in the second category. Sometimes the highest return trade is the one you don't take. In both cases, the principle is the same. You move with a plan, not with adrenaline. You let math and structure guide you, not noise and hype. Charts will keep flickering. Commentators will keep shouting. New headlines will try to yank your attention every hour. But underneath all of that, a slower story is unfolding, about energy, about currency, about trust in paper promises, and about what happens when real-world scarcity finally forces its way back into the price. Your edge is not predicting the exact day that inflection hits. Your edge is being positioned so you don't have to. Let your capital follow reason, not promotion. Decide what you'll do before the tape moves, and then have the discipline to stick to it when it does. OG out. When the metal and the message finally collide, only one of them will still be real.